Hey everyone, in this video, I'm going to compare two high-yield dividend stocks, Altria Group and British American Tobacco. These two dividend stocks offer passive income investors dividend yields above 9%. That's right, above 9%. So if you like really large dividends, then this video is for you. Now, I'm going to compare these two dividend stocks on more than just the dividend yield. That's where I'll start, but I'm going to go beyond that so that you can understand what your total return is. So we'll talk about that as well in this video. So this is going to be interesting. Let's dive right in.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, I told you these two companies offer really nice dividend yields. 9.53% for British American Tobacco and 9.25% for Altria Group. Really large dividend yields. Now, when you're investing in a dividend stock, it's important to remember that you're exposed to more than just the dividend yield. You're exposed to the changing stock price. If the stock price falls by more than 9.5% in a year, your total return could be negative, even though you got 9.5% on a dividend yield. So it's important to look beyond just the dividend yield to determine if your total return will be solid, not just your dividend yield, right? So that's something passive income investors sometimes forget to consider. They see these dividend stocks with these really attractive dividend yields and they want to jump right in, but they forget to consider the overall picture in what their total return could be with investing in this dividend stock. So that's what I'll elaborate on in this video. All right, so the next thing to look at when you're investing in a dividend stock is the payout ratio. Now, the payout ratio is essentially the earnings per share divided by the dividends per share. I'm sorry, the opposite. The dividends per share divided by the earnings per share. What that measures is how much of a company's earnings it's paying out in dividends. How much of the company's earnings it's paying out in dividends. Now, 100% is the maximum the company can do in the long run. In the short run, it can go above 100%. As you see here for Altria Group, it exploded above 500% at one point. That's because it could have had a moment where it paid a dividend per share, even though the company didn't generate profits in that quarter or in that year. Temporarily or one-off cases, it's okay. It happens. You have a quarter where you don't earn the profits you thought, or you have a restructuring, or you have layoffs and you need to downsize, and those severance costs eat into profitability. That's okay. But for the long run, to support a sustainable dividend, it needs to be below 100%. And each of these two is well below 100%. Altria Group at 76.84, British American Tobacco at 56.29. And you might be thinking, well, what does the company do with the earnings it doesn't use to pay dividends? It reinvests it in the business. It's called retained earnings. So management can choose what it can do with those earnings. It can pay it out as dividend. It can use it to buy back stock. It can reinvest in the company. It can pay down debt. All of those are choices management has to use earnings for, right? Dividends are just one use case for a company's earnings, for a company's profits. Altria Group and British American Tobacco each demonstrate economies in scale. Economies in scale is one of the most desirable characteristics you can find in an investment. In the example I have created here, sales grow from $100 in year 1 to $115.76 in year 4. While net income more than doubles from $4.50 to $9.47 in year 4. This company demonstrates economies in scale. As its revenue grows, its profits grow by a larger magnitude. Not every company can achieve this kind of effective growth. Here's how it works. This is a typical categorization of an income statement of a publicly traded company. Cost of goods sold is what's called a variable expense. That means cost of goods sold is connected to sales. Other expenses like interest, general and admin, and depreciation are not connected to sales. You can see here depreciation stays the same at 25 whether sales increase or not. The same is true for interest expense. It stays the same whether sales grows or not. You can understand your interest payments do not increase when your sales increase. Overall, businesses typically have a mixture of fixed expenses that are unrelated to sales and variable expenses that are. When sales increase, the business leverages those fixed expenses, as we see in this example, and profits grow by a larger magnitude than the increase in sales. That being said, you can see these two generate increasing operating profit margin, 61.6% for British American Tobacco, 56.06% for Altria Group, demonstrating excellent growth and excellent operating profit margins. The only company that I know of that has higher profit margins than Altria Group and British American Tobacco is Visa at 67% operating profit margin. And Visa is one of my top stocks to buy that I've been recommending for at least 2 years now, likely longer than that. These are right up there. MasterCard comes close, but I don't think it's above. It might be right above Altria Group. So these are the best of the best in terms of profitability of businesses worldwide. The next thing to look at is cash flow from operations to sales. Sometimes companies can have cash flow from operations that's different from profitability. Many times businesses have what's called non-cash expenses. Non-cash expenses. One example is stock-based compensation. When a company offers an employee a stock option, it needs to count that as an expense on the income statement. So that decreases profitability. But that's not a cash expense. When you give an employee a stock option, you're not giving that employee cash, are you? You're giving them a stock option. That's an option to buy stock at a certain price a certain few years from now after its vesting period is over. So that's not a cash expense. So that could differ cash flow from profitability. So it's important to look at both to see if there's any big difference. And you can see a big difference between these two in their operating profit and their cash flow. Their operating profitability is much larger than their cash flow from operations at 42% and 37%. In this case, Altria Group better than British American Tobacco at 42% compared to 32%. I will also note an interesting thing to consider here with operating profit margin. You see, I've pulled up this for the last 10 years and not just for the most recent number, because for me, it's important to look at the performance over a longer period of time and not just 1 year. This company could have had a specifically good year in the most recent year. And that's why the profit margin exceeded Altria Group in the last year. But if you look back longer term, Altria Group has demonstrated better profitability for the most part compared to British American Tobacco. So even though British American Tobacco has the better operating profit margin, if I was comparing these two head to head on operating profit margin and I was to rank which one has better profitability according to this metric, I would give the advantage to Altria Group because it's demonstrated this for more years, more consistently. That impresses me more than just a one-off beat of operating profitability just in the most recent few quarters or the most recent 1 year or 2 years. You've got to do more to demonstrate that you're more profitable than a company that's consistently been more profitable than you. I need to see more than just 1 or 1.5 year of profit exceeding. Okay, so that's something I will highlight. That's something I always look at. I don't give great value to these one-off events, these one-time things. I like to see consistent performance to earn the credibility of the performance. I also wanted to compare these two on long-term debt. I want to see who has more long-term debt. Generally speaking, the more long-term debt, it's a bad thing. So I'd prefer a company with less long-term debt, all else being equal. And in this case, Altria Group has less long-term debt compared to British American Tobacco, which has more than twice the long-term debt as Altria Group, the company borrowing to make some acquisitions, and that has increased its long-term debt. Finally, I want to compare these two on valuation. I want to see which stock is more expensive, because one stock could be better than the other stock on everything, on every financial metric. It can be better. But then you go and look at the price and it's way more expensive. Like comparing a Mercedes Benz to a Honda Accord, right? Of course, the Mercedes Benz is going to be better than the Honda, but the Mercedes is probably twice or three times more expensive than the Honda. So you might say, well, I know that's better, but I prefer the value I'm getting with the Honda. And that's what I look at with valuation. It's not the market price, it's the price to earnings that I'm interested in. What earnings am I getting for the price that I'm paying? And according to this metric, Altria is slightly more expensive at a forward PE of 7.847 compared to a forward PE of 6.495 for British American Tobacco. So, given everything I've looked at here and given everything I know about these two companies, which I've been following for several years now, if I had to pick between these two as my choice for better dividend stock to buy for 2024, I would choose Altria Group. Altria Group would be my choice. Although they are close, Altria Group edges out British American Tobacco as the choice for me as the better dividend stock to buy. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.